Hello everyone, and welcome to this video where we're going to be taking a look at equity release or lifetime mortgages in Voyant. I've got two plans that I want to share with you. One is a plan where a client doesn't have enough income and we're looking at using the equity in the property to help supplement her income needs in the plan. And the second plan, we're going to look at gifting a lump sum to children using the equity in the property. So first of all, let's take a look at Sarah's plan here. So Sarah is 71. She's got two goals in her plan. The first one being that she wants a basic income requirement of £9,000 a year. That will pay her bills. And she wants some additional spending of £10,000 per annum. So this is all the fun stuff on the top. Now, what we've talked about with Sarah is that when she gets to her age 80, it's likely that that additional spending will step down. So one of the features of Voyant is that you can step change your goals at any point in the plan, or points, because you might have a series of step ups or downs. And here we have reduced her spending at the age of 80 to £4,000. So let's take a look. I mean, we can see here that without even looking at a chart, we are not going to meet her additional spending needs for quite a significant amount of the plan. So let's now have a look at the assets that she has. So Sarah's got an emergency fund. Okay, so that's £4,000, but she wants to leave that there as an emergency fund. So what we've done with that pot is we've just put a withdrawal restriction on so that we would need to schedule any withdrawals. Of course, the option you've got as well, if you want to ring fence an emergency fund, is this do not allow withdrawal limit. Okay, so you can use either of those two. So now I'm going to check out her property value. So she has around £500,000 value in her home. The property is unencumbered, so it's got no current mortgage on it. And we've got some pension here. So we've got £80,000 in a money purchase pot, £9,000 in her state pension. So if we're looking at her timeline, we've got a very distinct set of stages in her plan. So we're enjoying retirement in these early years of the plan, so up to her age of 80. And then we've got our later life phase, which may require care or additional support in the home. We don't yet quite know what that looks like. But we're going to review this every year anyway, so as we move closer and closer to this later life period, we'll be able to plan accordingly. So when we go to the graphs and charts, let's take a look at some of the graphs that might be helpful for this plan. So first of all, we've got her cash flow. So in a very simple basis, we can see that her basic need, which is this blue line, is pretty much met all the way through the plan. And if I put the detail in, we can see that it's the state pension primarily that's going to be meeting her basic need. The money purchase environment here, the orange colour, is going to be using it up at quite a rate. So by the time she's 78, we'll have completely exhausted that pot. Okay, so the red is where we are now short and we're not able to meet our needs. If we look though at her assets in the plan, she does have a significant asset in her property. She has no plans to move. She really likes where she lives. Her neighbours look in on her and she's part of a community. So she really doesn't want to move from her home. But if she could leverage some of the equity in this property, she has no beneficiaries, no dependents. So she's quite happy to use some of the equity in her property to supplement her income and give her the standard of living that she would like to enjoy. We could take a look at the legacy at this point. So that's her potential inheritance tax and her estate position. She's not too worried about this because she's leaving most of her money to charity. Okay, so here we've got £90,000 in inheritance tax. In the insights, you could run her retirement spending or investment return simulation. The investment return will help inform us as to what she would actually need as an investment performance net of charges every single plan year if she were to rely on investment performance alone so that to meet her plan goals. So that would be 10.82%. And the retirement spending simulation is a really good one, because this will help us understand what would be a more realistic spending capacity if we were just to take that draw every year until she died. Okay, so that's 13,760. But that doesn't get her to where she needs to be. So what we can do is we can build our what if, and we're going to release income from equity in property. So we create our plan. Now how we do that is, now often what I'll do is when I'm presenting to a client, I will always switch off the chart in the dashboard so that I can use the information in the dashboard as almost a way to recap with the client that we've captured all the right information. But when I'm planning, I go to my preferences and I turn the dashboard chart back on, because I find that helpful then, so I can see the impact my changes are having immediately without having to keep navigating to the let's see. So in the plus sign, to put our lifetime mortgage in, we need to go to debts and loans. And it's this feature here, which is called line of credit. So I'm going to call this lifetime mortgage. So with your lifetime mortgage, you've got an option as to whether that is a fixed amount or a percentage of equity. So in this particular case, I'm going to say a percentage of equity. And I'm going to say that she can draw up to 50% equity out of her property. There is no current balance, so she hasn't done any borrowing or drawdown up till this point, so that's 0. And the interest rate on this loan is 2.25%. The payment type, and again, if any of these fields, if you're not sure what we're looking for, remember, if you switch on inline help, which is found in your preferences where I turn the dashboard chart on, you can, of course, click on the underlined part here or click on the question mark, and you'll see what we are looking for in that section. So inline help is pretty invaluable. So I'm going to show that Sarah is not going to be repaying the loan on a monthly basis, so we set payment amount to 0. There's another stage in this, in that with the withdrawal limit, as a default, it's set to do not allow. So I'm just going to change that to as needed. And then I'm going to click done. And, oh, here we go. We need to link an asset. Of course we do. Silly me. So there we go. So getting ahead of myself, I'm just going to link the property to the asset so that they know, so Voyant knows how much 50% of the equity is. There it is. So now, when the pension runs out, we are using the money from the equity release. If she wanted to keep this pension in the background, of course, what we could do with the pension is we could put a drawdown restriction on that pot, okay? And then what would happen is Voyant would be forced to use the equity release for those payments. But as we're not looking to keep the value in that pension, we're just going to leave that as needed. Okay, so we use all the pension income, and what we're demonstrating to Sarah is that later on in the plan we could draw equity from her property. So now if we're looking at the charts in a bit more detail, we can have a look at the debt chart and we can see how much that is increasing by each year. So not only are we taking the borrowing each year, but we're obviously not servicing that loan, so the interest is being added. Again, you can see that in more detail in the year view. So if you click in the year view and go to debt, you can see no payments being made and the balance is just rolling up because we're taking our draw, there's our draw, and then we are increasing by the interest rate each year as well. Might want to also look at the client's net worth at that point. Okay, so we can see her net worth. We could compare the two screens, okay? So we can compare our original plan without the equity release. And I suppose this isn't really a direct comparison because ultimately she can't do what she wants. She is going to have a shortfall. So it's not really a genuine like for like, because in the original version of the plan, there's a whole host of red in the plan. But from a net worth perspective, we can see the impact on her net worth here, as you know, as the draw of her property takes effect and goes later on into the plan. So this is really highlighting to the client some of the options that she has. If she hasn't got enough liquid assets to meet her need in retirement, then she could perhaps leverage some of the equity in her property. Of course, you could compare the impact on the legacy in the plan, so we can see what that would look like if you looked at the two side by side. Okay, and there is a saving because we are creating a debt on the estate. So in our plan where we release equity, we've got this £78,000 debt on the estate, which of course we don't have in the base plan because we're not using that property for income. So an interesting case study, okay, quite a simple one. Another type of case study that you might be interested in is where a client perhaps wants to draw a lump sum from their property. So here we've got Mary. Mary is a widow, and Mary has a retirement income need of around £36,000 a year, so £3,000 a month. Now Mary's in a different position to Sarah because she has some money in an ISA and some cash savings. She's got a bit more equity in her property because she owns a property worth 1.2 million. She's got her husband's final salary and his drawdown pots, and she's got her own state pension. She would really like to gift to her daughter next year in the plan to help her daughter pay off her own mortgage. Okay, so that's 300,000. And in the carryover assumptions, what we are reflecting is that Mary is carrying forward all of her late husband's nil rate band and RNRB. Okay, so she will get that benefit of those allowances as well. So in the dashboard here we can see that we've already got some red, so let's take a deeper dive at that. So if we were to just use her current assets to meet her need, then she would be forced to take quite a lot of drawdown income to make that gift to her daughter. And something that's worth considering is the tax. So she would pay £100,000 in income tax in that year to draw enough to give to her daughter. That then has a compounding effect because to pay the tax bill, we then have to draw a larger amount out of the pension because it's our only asset, which then causes another income tax liability the year after, and so on and so forth. So really, this isn't a great idea because, as you can see, it also leaves Mary very short. She's got some shortfalls in her plan. So is there another way for Mary to achieve this? Now, before we look at that, we could look at the legacy position. But again, it's important to remember that in this version of the plan, the only asset that Mary has left at the end is her property, really, and this emergency fund that we've not touched. Okay, so she's not basically achieving all of her goals. So if we go to a what if, we can call this plan lump sum out of the house for Brenda's gift. There we go. So Mary is gifting to her daughter Brenda. So what we are going to do now is to do the line of credit again. Okay, so we go to our plus sign, we go to our debts and loans and our line of credit. So this time we're going to call this lifetime mortgage for Brenda. It's a fixed amount this time, and the credit limit would be 300,000. Current balance is 0. Interest rate 2.25%. Again, it's a repayment mortgage and we're not making repayments, so we're going to roll up those payments again. We are going to now make the withdrawal limit scheduled only. So by doing a scheduled only withdrawal limit, this will allow us to then plan the withdrawals, which we're going to do in a moment. I'm going to first link to our property. There we go. So we've linked the property, we've set up the withdrawal limit. We now just need to go to the planned withdrawals, add our withdrawal, save and continue. If I put here, Brenda gift, 300,000, And the timing of that is here. So let's now look at how this is now shaping up for Mary. Okay, so here we see the reversionary mortgage coming in, so the 300,000 coming in, and Mary still has her basic £36,000 a year income need as well, so we're meeting that need. And actually, in this version of the plan, the ISAs are fulfilling her income need all the way through until she's 82, and then the drawdown pension is picking up the slack. So if we look at an asset position here for Mary now, not only does she still have her property, she's got her pension and some savings as well. Now, a better comparison is actually looking at the net worth. So I'm just going to do a quick compare of the charts, and we're going to start in the cash flow. So as we've already seen, Mary can't achieve her desired objective of helping Brenda and meeting her own income needs in retirement. Okay, so in the base plan, she just can't do it. But if we take out a lump sum, okay, what we can see is that she can take out a lump sum and she can meet her income needs. If we look at her debts, what we see is that 300,000 is slowly growing each year because we're not servicing that debt, okay? And at the end of the plan, we've got a total debt of 383,000 on the estate. We look at the net worth and we can see that, of course, that will reduce the value of the property, but as we've already seen, it does leave her with a pension asset which would have been completely exhausted in the base plan. Okay, so actually, ironically, the net worth in the second plan is better, which is quite unusual. So let's now take a look at the legacy position, because that's very important. And if we go straight to a comparison view, so we've got our base plan on the right, which is our original plan, and then we've got our plan where we are gifting out of the property. And of course, our taxable estate where we have the equity release is slightly lower because we have created debt on the estate, and you can see that in the detail. Okay, so there's the debt on the estate. What we do have left behind, though, of course, is money in a property, which will be outside of the estate. So what's quite a useful thing to do in the detail, okay, is to scroll all the way to the bottom of the screen and to see the net worth after tax. So this is essentially what the inheritance value to Brenda would be after she's paid any inheritance tax and taken any distributions out of the estate, like the pension here, which would be outside of the estate. So actually, even though the tax is lower, you'll see the net worth is really the key number here, because we can see there's 170 odd £1,000 difference in one plan to the other. And don't forget that not only is Brenda is £170,000 better off at the legacy stage, but she's also had the 300,000 20 years in advance when mum's given her the gift, and mum's been able to enjoy seeing her daughter pay off her mortgage and have that financial freedom. And also Mary has been able to still afford all of her lifestyle requirements until her mortality. So that's an interesting scenario. Of course, you can use any of the insights to help to demonstrate this, especially where there's an inheritance tax saving. The potential IHT simulation is a really nice insight. Shows you in simple terms the difference in one plan versus the other from an inheritance tax perspective, and the wider the jaws, the better the saving, of course. Very nice visual way to present that saving to the client. And of course, if you are doing a summary report for a client, we've got lots of options available to you, but quite a new report is this estate analysis. So if I just show you what that looks like, because it's particularly relevant for this family. The estate report is a customizable report. So what you can do is you can have either just the simple plan, okay, or you can have the details. So I'm going to include the details because we want to see that net worth after tax. and we generate that. And this is a nice handout for the client post-meeting, something you can send as a follow-on so that they've got a nice summary of what you discussed. So that's the flow chart for Mary's planned legacy in the base plan, okay? And then we've got the detailed numbers there that shows clearly the IHT that we're carrying, the IHT nil rate band we're carrying over from the husband as well, by the way, in case you wanted to check those details, but the net worth after tax. And then in the second plan, where we've got some planning, we've got the estate tax due, but also the net worth after tax and all of the calculations. So hopefully that gives you some idea as to how you might use lifetime mortgages in your planning with your clients. Of course, if you've got any questions, we would always encourage you to contact us on the support@planwithvoyant.com email address, and we're more than happy to look at some individual cases for you. But this is certainly an area of planning that we're getting more queries on, so please, if you need any help, do shout and we'd be more than happy to give you a lending hand. Hope you enjoyed the video. Have a great day. Thanks for watching.